The quiet truth about retirement catch-up contributions is that most people in their 50s who have the legal ability to contribute significantly more to their 401k and IRA accounts simply do not, and they lose thousands of dollars of lifetime tax advantage every year they hesitate. But there is a new wrinkle under the Secure 2.0 Act that has fundamentally changed how catch-up contributions work for a specific slice of workers. And it has created both new opportunities and new pitfalls depending on your income level and the specific structure of your employer's plan. If you are between 50 and 59 and still working, whether full-time, part-time, or as a consultant, and you have any amount of earned income, the next several years may represent the single best opportunity you have ever had to dramatically accelerate your retirement accumulation. This is also the window where the newest rule can backfire if you do not understand it. Margaret Ruth, a labor and delivery nurse from Duluth, Minnesota, learned this lesson in early 2026 when her employer's payroll system began sending her catch-up contributions to a Roth designation instead of her traditional pre-tax account, because her prior year's wages exceeded a new income threshold she had never even heard about. She did not realize what had happened until she reviewed her year-end statement and noticed the tax impact. The numbers matter. The rules have teeth. And the decade of your 50s is not a time to be passive about where your dollars are going. This video is for educational purposes only and is not personalized tax, financial, or legal advice. Consult a qualified professional for guidance on your specific situation. Now, let us walk through what has changed, who is affected, and how to optimize every remaining year of your 50s. Catch-up contributions are additional amounts. Workers age 50 and older are allowed to contribute to retirement accounts above the standard annual limits. The idea is to help people who got a late start on retirement savings accelerate their accumulation in the final working decade. For traditional and Roth IRAs in 2026, the standard contribution limit is $7,000, and the catch-up amount for those 50 and older is $1,000, for a total of $8,000 per year. For 401k, 403b, and most other employer plans in 2026, the standard limit is $23,500, and the catch-up amount is $7,500 for those 50 and older, for a total of $31,000 per year. Here is where Secure 2.0 introduced its major change. Starting in 2026, for workers aged 50 and above, whose prior year wages from that employer exceeded $145,000, the catch-up contributions to the employer plan must be made on a Roth basis. That means the contributions are made with after-tax dollars. They do not reduce your current taxable income, and the account grows tax-free for qualified withdrawals. For workers below the $145,000 threshold, catch-up contributions can still be made on either pre-tax or Roth basis at the worker's election, if the plan allows both. This sounds like a subtle change, but it has significant financial planning implications. If you are a high-income worker in your 50s, your catch-up contributions can no longer reduce your current taxable income when made to the employer plan. The tax benefit of the catch-up shifts from current deduction to future tax-free growth. For some workers, this is actually better. For others, it is worse. It depends on your current versus expected retirement tax bracket. There's also a new super catch-up rule that applies to workers age 60 to 63 specifically. Under Secure 2.0, the catch-up contribution limit for workers in this specific 4-year age window is increased to the greater of $10,000, or 150% of the regular catch-up amount. In 2026, that super catch-up is approximately $11,250 for a 401k, which is the regular catch-up of $7,500 multiplied by 1.5. Combined with the standard contribution limit of $23,500, workers aged 60 to 63 can potentially contribute up to roughly $34,750 to their 401k in a single year. At age 64, the super catch-up ends and the standard catch-up amount resumes. The super catch-up is available only if the employer's plan offers it. Not all plans automatically updated their documents to include the new provision. If you are between 60 and 63, check with your HR department to confirm whether the super catch-up is available in your plan. Let me walk through the practical implications with examples. Arthur, a retired postal worker turned part-time consultant from Kansas City, Missouri, is 61 years old. He consults for a small engineering firm that offers a 401k with the super catch-up provision added in 2026. Arthur earns $70,000 a year from the consulting work. His prior year's wages were $72,000, which is well below the $145,000 threshold that would trigger the mandatory Roth catch-up rule. That means Arthur can contribute the standard $23,500 plus the super catch-up of approximately $11,250, all on a pre-tax basis if he chooses. That is nearly $35,000 going into tax-deferred accumulation, reducing his current taxable income by that same amount. At a 22% federal bracket plus state tax, that is roughly $7,700 in current tax savings, plus the future growth benefit, Arthur is using his early 60s to massively accelerate his retirement accumulation in the exact years before RMDs begin. Now compare to Dorothy, an anesthesiologist from Miami, Florida, also age 61. Dorothy earned $380,000 in her prior year at the hospital where she works. Because her prior year wages exceeded the $145,000 threshold, her catch-up contributions must be made on a Roth basis. Dorothy can still contribute the same $34,750 total, but only the base $23,500 can be made pre-tax. The approximately $11,250 catch-up amount, including the super catch-up, must go in as Roth. Those dollars do not reduce her current taxable income, and Dorothy is in the 32% federal bracket. On the surface, Dorothy is losing an immediate tax deduction of roughly $3,600 on the catch-up amount, but because her catch-up goes into a Roth 401k, those dollars will grow tax-free, and when Dorothy withdraws them in retirement, the withdrawals will not be taxed, not increase her Social Security taxation, and not trigger IRMA surcharges. For a high earner who expects to remain in a relatively high bracket in retirement, the Roth catch-up is often actually more valuable over the long term, even without the current deduction. The third example is subtly different. Consider Eleanor, a retired school teacher from Austin, Texas, who returned to work at 60. As a part-time tutor earning $40,000 a year, because her prior year wages were only $38,000, she can contribute catch-up on a pre-tax basis. But because the amount she can contribute is limited by her actual earned income, she can put away only up to her total earned wages. If she contributes aggressively to her IRA and her small employer's 401k, she may be effectively sheltering a substantial portion of her modest income from current tax, while simultaneously building retirement assets for her later years. The strategic use of catch-up contributions in a low-wage year can produce unusually high relative tax efficiency. Let me cover the specific rules and coordination points you need to know. Rule 1. The $145,000 wage threshold is based on your prior year's wages from that specific employer, not your total income from all sources. That means if you have multiple employers, or if your income comes from a mix of wages and self-employment, the threshold is calculated per employer. Self-employment income is not counted in this particular calculation, though. It has its own separate rules for solo 401k plans. Rule 2. The threshold is adjusted annually for inflation, so it may be slightly higher in future years. Always check the current year's specific number with your plan administrator or a qualified tax professional. Rule 3. The Roth catch-up requirement applies only to employer plans. It does not apply to IRA catch-up contributions. Your IRA catch-up contribution of $1,000 can still be made to a traditional IRA, deductible if you qualify under income limits, regardless of your wages from any employer. Your ability to deduct traditional IRA contributions depends on whether you are covered by an employer plan and your modified adjusted gross income, with phase-out ranges that differ by filing status. Rule 4. If your employer's plan does not offer a Roth 401k option, and the new rule would require you to contribute the catch-up as Roth, you cannot make a catch-up contribution to that plan at all in 2026 and beyond. This is a significant issue for plans that have not yet updated. Advocacy groups and plan administrators have been pushing hard for plans to add Roth options, specifically because of this rule. If you are a high earner at a company without a Roth 401k option, talk to HR about adding one or consider alternative retirement vehicles. Rule 5. The super catch-up for ages 60 to 63 is an additional benefit, not a replacement for the standard catch-up. If your plan offers it, the super catch-up replaces the regular catch-up amount for those 4 specific years. The moment you turn 64, you revert to the standard catch-up amount. Rule 6. Catch-up contributions are subject to the overall annual additions limit, which includes your contributions, employer match, and any after-tax contributions. The overall limit for 2026 is approximately $70,000 combined. For workers under 50, or $77,500 including the standard catch-up, or approximately $81,250 including the super catch-up. These numbers matter if your employer offers a generous match, because you need to ensure your contributions plus the match do not exceed the overall limit. 3 specific traps to watch for. Trap 1. The wage threshold look-back surprise. You might plan your contribution strategy at the beginning of the year based on your expectations, only to find out mid-year that your prior year wages actually exceeded the threshold because of a bonus, commission, or other payment you forgot about. Your payroll system will adjust your catch-up contributions to Roth automatically, but you may find the tax treatment different than you expected for the year. Run your numbers carefully in January and confirm your prior year wage total before setting up contribution elections. Trap 2. Missing the super catch-up window entirely. The super catch-up is available only at ages 60, 61, 62, and 63. If you turn 64 during a calendar year, you may still use the super catch-up for that year if you are 63 at the end of the prior year, but the details depend on your plan's specific implementation. The window is narrow. Do not waste it. Workers in this specific age bracket should be maximizing contributions every single year. Trap 3. Forgetting IRA catch-up on top of the 401k. Many workers focus on their employer plan and forget that they can separately contribute up to $8,000 to an IRA each year after 50, assuming income limits allow. For a high earner, the traditional IRA contribution may not be deductible, but a backdoor Roth conversion can still put the dollars into a Roth IRA with its own tax-free growth. Do not leave the IRA capacity on the table. Now let me walk through how to structure the decade of your 50s for maximum benefit. The framework I recommend is simple. First, always maximize your 401k or 403b contribution to the highest amount your income and plan allow, including catch-up if you are 50 or older. Second, always fully fund your IRA, either traditional or Roth depending, on your deduction eligibility and long-term strategy, including catch-up amounts. Third, if you have an HSA through a high deductible health plan, fully fund that too. Fourth, if you have additional income available, consider after-tax contributions to your 401k if the plan allows, combined with in-plan Roth conversions or in-service rollouts, which is sometimes called the mega backdoor Roth strategy. Harold and Helen, a couple in their late 50s, both working full-time in Columbus, Ohio, ran this framework aggressively in their final 6 years before retirement. Harold, an attorney, earned $180,000 and was subject to the Roth catch-up rule. Helen, a project manager, earned $95,000 and qualified for pre-tax catch-up. Between the two of them, they contributed a combined $72,000 a year to their 401k plans, plus $16,000 to IRAs, through backdoor Roth conversions, plus $8,500 to a family HSA. That is over $96,000 a year going into retirement accounts. Over 6 years, they accumulated an additional $600,000 in retirement balances on top of what they would have accumulated at the standard contribution levels. The current year tax savings from the pre-tax portions alone averaged around $11,000 a year, or $66,000 across 6 years. The future tax-free growth on their Roth portions is substantial. This is what structured catch-up planning can do in a single decade. If you are at the lower end of this age range, 50 to 55, the standard catch-up amounts apply. Focus on consistency. Maximize the 401k, plus standard catch-up. Fund the IRA plus catch-up. Fully use the HSA if you have one, and don't forget spousal IRA contributions if one spouse has lower or no earned income. If you are at the middle of this range, 56 to 59, begin coordinating with the super catch-up window that opens at 60. Map out the next 4 years specifically. How much can you put into each account every year from 60 through 63? What is the cumulative amount? Does your plan offer the super catch-up? If not, ask HR to add it, or consider rolling a portion of your balance to an IRA or a solo 401k after separation if you are eligible. If you are already in the super catch-up window, 60 to 63, maximize every single year. These are the most concentrated contribution years available under federal tax law. Losing even 1 year of super catch-up contributions can translate into $50,000 to $100,000 of foregone retirement accumulation by age 85 after growth. This is not hyperbole. The math is stark. Every year in the super catch-up window is worth approximately 3 normal contribution years in total lifetime accumulation value because of how compounding works over the subsequent 25 years. A final planning point. For workers between 50 and 59 who are currently sitting on significant after-tax savings in taxable brokerage accounts, one strategic move is to live on the taxable account savings during these peak contribution years while routing all current earned income into tax-advantaged accounts. The net effect is that you are essentially converting taxable money into tax-advantaged money while capturing the current year deduction or the future tax-free Roth growth on the contribution amounts. This is legal, efficient, and widely used by high earners in their peak catch-up years. 3 action items for you right now. First, confirm with your HR department or plan administrator whether your employer's 401k plan offers a Roth option, super catch-up for ages 60 to 63, and any after-tax contribution capability. If any of these are missing, ask for them to be added. Plans do update when employees ask. Second, pull your most recent 401k statement and calculate whether your current contribution rate is capturing the full catch-up amount. Most workers are contributing less than the maximum, often significantly less, and updating the election takes 3 minutes in most plan portals. Third, talk to your tax advisor about coordinating your catch-up strategy with Roth conversions, HSA contributions, and IRA contributions to produce the best combined outcome for your specific tax situation. Subscribe to the channel for next week's walkthrough of first RMD timing for the class of 2026, which is specifically designed for retirees who turn 73 this year. If this video helped you understand something your employer never explained, please share it with a friend or colleague in their 50s. The rule changes are new enough that even many HR departments are still catching up, and a good forward from you could be worth thousands of dollars in someone else's retirement. Take good care, make the most of your 50s, and I will see you in the next one.